Hello investors. Today we will explore the growth story of CCL Products Limited in the coffee industry. In this video, we will cover industry trends, CCL's business model, financial performance, future growth, valuations and risks. Don't miss out on this exciting opportunity. Let's get started. Coffee is a highly popular beverage worldwide, with over 2.25 billion cups consumed daily. It is primarily produced in developing countries and imported by developed countries. Key coffee producers include Brazil, Colombia, Vietnam, Indonesia, Ethiopia, and India, while major importers include the US, European Union, UK, and Japan. The global market for instant coffee is valued at 42.5 billion USD in 2023, and it is projected to grow at a CAGR of 5% for next decade. By the end of 2033, the sales of instant coffee worldwide are expected to reach 69.2 billion USD. Instant coffee is popular due to its ease and speed of preparation, which is expected to drive demand in the next decade. It is made from roasted or manufactured coffee beans and can be prepared through two main methods. Spray drying, where coffee extract is sprayed into hot air and dried into small pieces or fine powder. And freeze drying, where coffee extracts are frozen, cut into smaller pieces, and then dried at low temperature in a vacuum. Compared to brewed coffee, instant coffee contains less caffeine but higher levels of antioxidants. Regular consumption of instant coffee has been associated with benefits such as boosted metabolism, improved liver health, and enhanced brain functions. The share of instant coffee in total coffee consumption has increased from around 25% to 35%, while the share of fresh coffee has declined from approximately 75% to 65%. Nestle and Kraft Foods are the dominant players in the market, accounting for over 50% of the market share. Nestle holds a significant portion, representing 30% of the world's total instant coffee volumes. However, there is a growing segment of private label instant coffees sold by other retail brands and supermarkets, with a market size of around 4.5 lakh metric ton per annum, which is also part of CCL's target market. CCL Products Limited is the largest coffee processor in India and operates the world's largest single location plant for converting raw coffee beans into instant coffee granules or powder. While coffee processing may seem like a commodity conversion business, it requires specialized expertise to maintain consistent flavor and quality batch after batch, regardless of the input quality or grade. This has resulted in limited competition and high profitability in the global coffee industry. CCL holds a prominent position as one of the largest green coffee beans processors globally. It has a significant market share of 38% in India's instant coffee exports and is a leading supplier to private label brands worldwide with 10% market share. The company produces over 250 blends of instant coffee for renowned business coffee manufacturers in more than 90 countries, focusing on its export business. It operates the world's largest private label manufacturing facility with capacities of 35,000 metric tons, including 24,000 tons for spray-dried coffees and 11,000 tons for freeze-dried coffee. CCL has established a state-of-the-art soluble instant coffee manufacturing plant in Andhra Pradesh, India, under its subsidiary Continental Coffee Private Limited to cater to the domestic market. Additionally, it has a large-scale plant in Vietnam, contributing around 40% of the company's consolidated revenues. To serve the European region, CCL has set up an agglomeration and packaging unit in Switzerland. The company also has a subsidiary in Singapore focused on brand acquisitions. In the domestic market, CCL engages in business to business manufacturing of instant coffee for private label brands and operates a business to consumer segment under its own Continental brand. The company is actively building its brand and has established a distribution network of 75,000 outlets, holding a 4% market share in South India. The branded business is projected to grow rapidly at a rate of 30 to 35% over the next few years, with a revenue target of around 300 crores in 3 years. CCL is aggressively pursuing the coffee vending business and is installing machines for large clients across India. In FY23, the group achieved a turnover of Rs 2071 crores, surpassing the milestone of Rs 2000 crores compared to Rs 1462 crores in the previous years. The growth in revenue was driven by a 20% increase in volumes and a 21% boost from higher coffee prices, resulting in a total revenue growth of 42% for the year. Vietnam operations accounted for nearly 40% of the consolidated revenues and reported a net profit of Rs 140 crores in FY23. Around 50 to 60% of the company's revenues come from existing customers, while efforts to add new customers remain a focus. The EBITDA per kilogram for spray dried coffees ranges from Rs 90 to Rs 100, while for freeze dried coffee it ranges from Rs 130 to Rs 140. Over the past 2 decades, the company has expanded its capacity by 10 times without diluting equity and has maintained a controlled level of debt. The debt to equity ratio has consistently remained below 1 for the past decade, and the interest coverage ratio has been maintained above 10. The company has consistently paid dividends, maintaining a payout ratio of approximately 25%. The earnings per share has shown continuous growth, increasing from 3.57 in 2013 to 20.21 in 2023 at a CAGR of 19%. The EBITDA margins have normalized to 20% after reaching an all-time high of 25% in 2020, while the net profit margins have improved from 7.28% in 2013 to 13% in 2023. The return on assets and return on capital employed have stabilized around 20% after reaching highs in 2016-2017, and the ROA remains healthy at 10.35%. The promoters continue to hold more than 45% stake in the company, while DIIs have increased the stake in recent quarters to 21.06%, while FII continue to hold around 7% stake in the company. CCL Products Limited has distinguished itself in the market through its focus on research and development, resulting in the creation and sale of unique products. The company offers more than 250 customized blends of instant coffee to cater to the specific needs of clients in 90 countries. This has fostered customer loyalty as clients value the consistent quality and taste provided by CCL. A key differentiator for CCL is that it is the only company worldwide offering all types of instant coffee blends from a single location. This not only saves customers on logistical costs but also eliminates the hassle of sourcing from multiple locations or vendors. Additionally, CCL has its own packaging facility, providing various packaging solutions that gave it a competitive edge. As one of the largest global producers of instant coffee, CCL enjoys advantages in terms of cost and efficiency. The company claims to possess superior technological knowledge, having acquired equipment from Brazil. This allows CCL to utilize lower grades of green coffee beans while still producing high-quality instant coffee, giving them a competitive edge in terms of production cost. Over the years, the company has improved its utilization levels, resulting in higher EBITDA per kg due to positive operating leverage. The management has set a target of achieving an EBITDA per kg of Rs 130 to 135 by 2024, compared to approximately Rs 110 in FY21, primarily driven by increased contribution from value-added products. CCL has established a long-standing presence in international markets, with many customers remaining with the company for over 15 to 20 years. The top 15 clients contribute to 60% of the revenue, with Strauss Coffee being the largest client, accounting for 10% of the revenue. To maintain stable margins, CCL follows a procurement policy of procuring raw materials only after receiving orders. The company places orders for green coffee beans at spot prices while simultaneously pricing contracts to clients, safeguarding itself from any volatility in coffee prices. CCL strategically located its plant in the Dak Lak province of Vietnam, known as the Robustica capital of the world, as Vietnam is the largest producer and exporter of coffee globally. This strategic location ensures uninterrupted raw material supplies, low inventory requirements, and low logistic costs for CCL. Furthermore, CCL enjoys no tax benefits for the entire lifetime of the company in Vietnam, provided it meets the conditions of minimum employment and environmental governance. CCL Products Limited has recently commissioned its spray-dried coffee facility with a capacity of 13,500 metric tons in Vietnam during the March 2023 quarter. The company plans to gradually increase the capacity utilization and aims to achieve 50% utilization of 13,500 metric tons in FY24. Additionally, CCL has announced the commissioning of a freeze-dried capacity of 5,500 metric ton in Vietnam, scheduled for H2 of FY 2025. With this expansion, the total capacity at Vietnam facility will reach 35,500 metric tons. Furthermore, CCL is expected to commission a new spray-dried coffee facility with a capacity of 16,500 metric ton in Tirupati, Andhra Pradesh by the end of FY24. The capital expenditure for this project is expected to be around Rs 400 crores, with CCL contributing about Rs 80 crore, while the remaining amount will be financed through debt. In terms of market expansion, CCL plans to focus on social media advertising and direct-to-customer platforms for branded sales in the rest of the Indian market. The company aims to add 20,000 to 30,000 outlets this year in South India and increase its presence in plain sachet and small packs. Additionally, CCL plans to target premier outlets in cream layers of cities and towns as it expands to other cities. The branded business segment is expected to grow at a pace of 30 to 35% over the next 2 to 3 years, with projected revenue of around Rs 300 crores in 3 years. While the capex may increase the debt on CCL's books and limit free cash flows in the near term, the company's demonstrated ability to generate cash in the past provides confidence in the long-term viability of its business model. CCL is the second largest manufacturer for private label instant coffee, second only to Nestle. With the capacity expansion, CCL's capacity will be more than twice that of the third largest player in the market. Based on the projected revenue growth of 10% in FY24 and 15% in FY25, along with a healthy EBITDA projection of 20%, the earnings per share is expected to grow to 23.1 in FY24 and 28.3 in FY25. Considering the current market price and the projected earnings in FY25, the company is trading at 23.1 times its projected earnings. Given the recent run-up in the stock price, I prefer to wait for a correction before entering into the stock. Currency volatility. CCL's revenue heavily relies on exports, accounting for approximately 90% of its total revenue. This exposes the company to fluctuations in current exchange rates. However, around 75% of its raw materials are imported, creating a natural hedge for transactions conducted in US dollars. Changes in duty rates. CCL supplies coffee to more than 90 countries from India and Vietnam. Any unfavorable changes in import or export duty rates or the imposition of non-tariff barriers in any of these countries could impact the competitiveness of the company's supply from Vietnam and India. Slow expansion of branded business. CCL is cautiously expanding its Continental brand in the domestic market. While it has received a positive response thus far, any negative customer feedback could affect the company's growth prospect and financial performance. Credit risk. As approximately 95% of CCL's business operates in the B2B sector, credit risks are present. However, most of the company's business come from repetitive orders with established clients, and CCL has a clean record with no major instances of bad debts in its history. Supply chain disruptions. Given the high level of uncertainty in the micro environment and geopolitical relations, disruptions in the supply chain poses a significant risk that needs to be monitored closely.